For you folks that would love to participate in a Roth IRA, but you've never been able to because of your income, then a backdoor Roth IRA may be a really good option for you. Hello everybody, today we are going to talk about backdoor Roth IRAs. This is Ray Halstead. I'm here with Andrew McMillan. We are CPAs with REH CPAs. Andrew, what can you tell us about backdoor Roth IRAs? They're actually, they're a pretty good tax planning tool for people to use. What can you tell us about it?
They are. So to help explain a backdoor Roth IRA, you kind of have to understand the two different individual retirement accounts available to you. So you can either do a traditional IRA or a Roth IRA. And again, we're talking about individual retirement accounts. We're not talking about 401k plans through your employer or any of those.
IRAs.
These are individual IRAs. So when it comes to individual IRAs, you can either take a traditional IRA, put money into that, and typically those, you put money into a traditional IRA, you get an immediate tax deduction on your tax return, and then when you go to retire, right now, after 59 and a half, when you pull that money out, it's taxable income to you. You get a deduction now, and then when you pull it out in retirement, it's taxable income.
Right.
Roth IRAs are kind of the opposite. You put money into it now, you do not get a tax deduction for it.
After tax.
It's after tax contributions, and then when you pull it out in retirement, it's tax-free. So you get the tax-free growth of all those earnings. So it's a really great vehicle for saving for retirement.
Right.
But the kicker is it's not available to everyone. High income earners, and when I say high income earner, it's kind of like if you're single making around 130, 150 plus, you're kind of getting into that high income tax bracket. Married individuals, 180, 200 plus, once you're, these
Start
rates,
phasing out
these
your
phase outs
ability to-
change every year, so it's kind of hard to just say, well, this is your number. Just be aware that if you're getting into some of these upper thresholds, you're gonna have some limitations. So if you're covered by a retirement plan, and what that means is if you're a W-2 employee and you have a retirement plan through work that you're already utilizing, making 401k plans through, if you're covered, the IRS is going to start limiting the amount that you can take as a tax deduction on your tax return when you put money into a traditional IRA.
Right.
If you're covered. So they basically say, this guy's making a lot of money, he's already maxing out his 401k through his work, we're not going to also let him now do a traditional IRA deduction and take it, he's got to start paying some tax. They got to start paying some tax. So if you're a high income earner, you're covered, and you want to contribute to a traditional IRA, you can always contribute to a traditional IRA, but it may not be deductible. So you make what's called a non-deductible contribution on your individual tax return.
And you build what's called basis.
You build what's called basis. Basis is really important to remember in this example, because now you've got basis in your traditional IRA, which can now be converted over to a Roth IRA. So.
Right, I guess so. As far as with whenever you first make that contribution, if you make that non-deductible contribution to that IRA and you have basis in it, and then whenever you go to pull that out later, you won't pay tax on that basis portion, just the earnings piece on that IRA when you do that non-deductible IRA contribution.
Right. So for high income guys also, they say that you can't even contribute to a Roth IRA. It's different than a traditional. Like you can always contribute to a traditional, you're just trying to figure out if you can deduct it or not. If you're a high income guy, you cannot contribute directly to a Roth IRA. They don't even give you that option.
Right.
So that's hence the backdoor Roth IRA is your only vehicle in order to get money into a Roth IRA. So what you do when you do that is you make a non-deductible traditional IRA contribution, and then you convert that to a Roth IRA. So when you do that conversion, you don't have that basis that you had in that traditional IRA gets converted over to the Roth IRA, so you essentially get to the same place.
And the biggest advantage to doing that versus leaving it as a non-deductible traditional IRA with basis, when you convert that to the Roth and it's a full 100% conversion, then you won't pay tax on the basis or the earnings.
Yeah, the biggest basis
it's
the
a
earnings.
much better, it's a better situation
It really is.
than just a non-deductible IRA with basis.
Yeah, there's definitely some things that you want to talk to your tax preparer to make sure that
Your financial advisor as well.
If you're a financial advisor, it's trying to explain a complex thing to do. Like there's there's a couple things you want to be aware of. There's this pro rata rule, which basically says if you have deductible and non-deductible contribution into an IRA, there's a pro rata rule, which is a calculation that you have to do to figure out how much of that conversion is
So
taxable.
it's not always 100% conversion. If you have IRAs
Yes.
in hand now,
Yeah.
and you try to do this conversion, you may not get 100% be able to move all of that to a
Right,
Roth.
right. Like for example, let's say that you just made your first non-deductible contribution into your IRA of $6,000, and your IRA is worth $100,000, and you've got deductible contributions in there as well. So you have to do a proration. So you say, well, my basis is $6,000, my IRA is $100,000. The proration of that, the division of that is now you've got 6% that you have to multiply by the 6,000 that was converted,
Right.
and that's your tax-free portion. So in that example, your tax-free portion is $360.
So for some folks, it's not that great of a deal. If you have a bunch of IRAs already, it may not be that great of a deal. But if you're one of these guys that you're traditionally doing most 401k, and then you want to start doing these, you want to start getting into a Roth, and you're not holding a bunch of IRAs, that's when it works the best. When you don't have any other IRAs on hand, and you want to do these backdoor Roth IRAs, you're doing it every year, the full amount, moving it over,
Yep.
then that's when it works the best.
Yep, and you just want to make sure you get it reported on your tax return correctly. Let your taxpayer know that you did some backdoor Roth
Yeah,
IRA.
because it's definitely
because
tracked on the tax
It's tracked
return.
on the tax return. You got to fill out a form 8606, and that you're going to get a 1099-R at the end of the year that looks like it was a taxable distribution. So unless you tell somebody, they're going to think
They're
that it's
gonna think-
taxable.
yeah.
So you need to make sure that you get that reported on your tax return correctly, so it's not taxable, and it gets your Roth IRA conversion basis calculated, because you want to calculate that through these years so that you don't have to figure out what your basis is in retirement,
Right.
and try to work those numbers. So
No, that's really good information. So for you folks that would love to participate in a Roth IRA, but you've never been able to because of your income, then a backdoor Roth IRA may be a really good option for you. Definitely talk with your financial advisor if you have one, but absolutely talk to your CPA as well. Man, that's awesome, Andrew. That's really good information.
thanks.
Yeah. So if you would like some more information about backdoor Roth IRAs, or you think that you may be a good candidate for us, and you want to reach out to us, it's rehcpas.com. Fill out the contact me form. We'll get with you and see how we can help. This is Andrew and Ray. We appreciate it. Thanks.